think high-end real estate is cooling. Toll Brothers earnings say the opposite. The reversal already started. Orders are dropping, prices are rising, and wealthy buyers are pulling back. The next move in this market is nothing like what you think. Hi everyone, this is Deep Dive Stock Earnings. Toll Brothers just released their fiscal Q for 2025 earnings. And honestly, the moment I saw the numbers, I immediately felt that this entire industry is about to get a lot more interesting. Because what you're looking at here is not just a quarterly report from a luxury home builder, it's basically a real-time thermometer for the high-end U.S. housing market. And today I'm going to break this report apart for you piece by piece. You're going to see a new revenue record, the pressure showing up in margins, the shifts inside their order book, the logic behind their strategy, and most importantly, whether this industry is actually entering a new cycle, because Toll Brothers isn't just selling luxury homes. It reflects the behavior of wealthy buyers, how money is moving, and what the interest rate environment is really doing. Alright, let's start with the numbers, because they already tell you exactly where this company is right now. This quarter, Toll Brothers delivered $10.84 billion in revenue, the highest in company history. They delivered 11,292 homes. So the volume is absolutely there. Operations didn't slow down at all. But when you look one layer deeper, you immediately spot something crucial. EPS dropped from $15.01 last year to $13.49 this year. At first glance, that looks like a big decline, but it's actually an illusion. Last year had a massive one-time land sale gain. If you strip that out, their real EPS last year was $13.82, and when you compare that, you realize EPS didn't collapse, it just slipped a little. In other words, revenue hit a record high, but profits didn't fully follow. The gap is the real story of this earnings report. Why did it happen? The answer is margins. Their Q for homebuilding gross margin dropped from 27.9% last year to 27.1% this year. It's only an 80 basis point drop, but don't underestimate it on billions in revenue. Not 0.8% is real structural pressure. It tells you two things. First, they had to use more sales incentives in certain regions to keep deals moving. Second, cost pressures haven't fully gone away. High rates, material volatility, labor costs, all of that is still inside the margin profile. But honestly, the margin decline is not the most important part of this report. The real spotlight is on their orders, their backlog. Backlog determines visibility for the next couple of quarters and sometimes the next year. And this quarter, backlog value dropped from $6.05 billion to $5.05 billion. And backlog units fell from almost 6,000 homes to about 4,600 homes. That's not a minor dip, that's a real contraction of over 20%. But don't jump to conclusions yet, because behind these weak numbers is a strategic shift. Even though they have fewer orders, the price per home in backlog actually jumped by about $100, from $1.08 million to $1.18 million. Toll Brothers is clearly filtering their customer base, letting go of rate-sensitive semi-luxury buyers, and only keeping the truly wealthy buyers who can pay cash or simply don't care about mortgage costs. Does this strategy come with risk? Absolutely. Just look at their Q for contracts, still softer than last year, and the key indicator, the cancellation rate, jumped from 5.9% to 8.3%. What does that tell you? Even high net worth buyers are starting to feel interest rate pressure, macro uncertainty, and slower transaction cycles. And in my opinion, that cancellation rate is the biggest warning light in the entire report. Alright, let's talk geography, because the regional breakdown basically exposes all the contradictions in this quarter. The strongest region is the Pacific, basically California. Average home prices there crossed $1.05 million, higher than last year, and demand remains solid. That tells you the true top-tier market still has real strength. The weakest region is the South, lower volume, lower prices, and heavier competition. In other words, the U.S. housing market is splitting. It's not up or down together. It's high-end staying strong, mid-tier under pressure, and lower tier essentially stalled out. And everything points to one conclusion. Toll Brothers is doubling down on the buyers least affected by interest rates. Now the question is, are they still expanding? Yes, absolutely. They control more than 76,000 lots right now, and active selling communities grew from 408 to 446. This tells you they're not contracting, they're preparing for the next housing cycle. And their fiscal 2026 outlook makes this even clearer. They expect fewer deliveries next year, around 10,300 to 10,700 homes, but they expect average selling prices to rise again to between $970,000 and $990,000. So volume goes down, price goes up, exactly aligned with everything we just talked about. Go higher end, go more resilient, go more premium. But there's one number people keep ignoring, and I think it's incredibly important. Next year's gross margin guidance is 26%, a continued decline. What does that mean? It means they expect more pricing competition in the South, possibly higher land costs, and maybe more incentives needed for certain buyers. Margins are the lifeline of home builders. When they fall, the entire valuation will raise lower. So why does management still sound optimistic? Because they made a major strategic move this quarter, exiting the apartment business. The sale to Kennedy Wilson didn't just bring in cash. It brings Toll Brothers back to its core identity, building and selling luxury single-family homes. And the projected extra $130 million in other income next year comes directly from this shift. Now let's talk about something more so but absolutely essential. Wealthy buyer behavior is changing. Rising cancellation rates are not just numbers, they're a sentiment signal. They're telling you that even the luxury market is not invincible. It reacts to rate cycles, asset prices, stock market. Wealth affects all of it, and this why Toll Brothers stock movement after earnings is extremely important. When I looked at the chart, I noticed a clear pattern: slow grind up plus sharp corrections plus base rebuilding. This isn't a tech stock chart. This is a classic cyclical stock structure. When fundamentals strengthen, the stock moves slow, but when the cycle turns, the trend becomes very clean. Alright, let's bring this entire earnings report together into one core conclusion. Toll Brothers' story isn't about good or bad. It's about segmentation and selection. The company is selecting richer customers. The market is splitting into strong regions and weak ones. Margins are being pressured by costs and incentives. Order volumes are falling, but order values are rising. When you put all of that together, you realize this isn't an exciting, flashy earnings beat. It's a report revealing the true state of the U.S. high-end housing cycle, and what it tells you is simple. Luxury real estate is not dead, it's just narrowing to the buyers who truly qualify. This is Deep Dive Stock Earnings. I'll see you in the next one.